difference between your statutory accounts, your management accounts and your budgets. And that makes people uncomfortable. They don't like differences. Why are you reporting to us on a monthly basis very different numbers than what we're putting out to the market or to the public at the end of the year? So when we're looking at this, as I say, please don't wait. People have been focusing on 2020 and saying that's a really long way away. It's really not. If you're a June year end, 1st of July 19 is when we start for leases. You've already started for your revenue in the for-profit space. And given that Australia shuts down for January, still fascinates me every year, we've got not a lot of time to actually be getting ready for this. So that's my first comment, is the time frame. Please be aware of this. Please make sure that you are bearing in mind the starting date, not the ending dates. The biggest issues I am seeing in regard to these standards are comments like these. They don't affect me. It's got absolutely no impact. How can my revenue possibly change? Most entities I've worked with have had significant changes in their revenue. It may not have resulted in as obvious an impact as what I think the leases are going to be, but there has been some significant changes, and I'll talk through some of those as we go through. What I think we are finding is when entities say to me, there is no change, and I say to them, okay, how do you know? Well, how would our revenue possibly change? Have you done any analysis of it? No. And that's the issue. If you genuinely present me with a paper and you say, I've looked at this, I've looked at the standard, there is no change, then I can look at your analysis and say, yeah, okay, I agree with you. If you tell me there is no change and you've done nothing to actually look at it, that's where the concern kicks in. And that's the panic phone calls I'm getting, is when auditors are rocking up and saying to their clients, tell me what you've done about revenue, and they go, there's no change. But you actually have to go through the particular process to do that. So let's talk about some of the other specific issues I'm seeing. The first thing, and I've done them in order of the 5 steps, so I've pulled out some of the key issues in relation to that. What is the contract? So we talk about identify the contract. How many pieces of paper make up the contract? Because often people hand me a contract and we say, here you go, here's the contract. And I say, is that it? Oh yeah, that's it, that's the whole contract. Well, based on what you've given me, my answer is X. That doesn't sound right. Maybe have a look and see if there's other bits of the contract. There might be a master agreement that sits in place over all the individual project agreements. There might be an amendment, there might be a variation. As we actually look at all these bits of paper, potentially we get different answers, because each bit of paper is telling us something different, and we need that whole story in order to work out how we account for our revenue. So both in the not-for-profit and the for-profit space, think about what actually makes up the contract. Don't just grab the most recent document, because there could be things going back from a while that actually govern the whole arrangement, particularly if it's clients or customers you've had for a long time. And then we consider, what do we actually do? So as finance people, do we actually know what our sales team are doing? What is a customary business practice within the industry? What's a goodwill gesture within the industry? Because under this standard, we account for customary business practices. We account for what we actually do, not what the contract says. So coming back to that substance over form, if we regularly say to people, you know what, if it doesn't work, we'll offer you or if it doesn't work for you, we'll offer you a refund, or we'll throw in a free service, or we'll do something else because that's what the industry expects. We have to know that, and we have to understand what the impact is for accounting purposes. So it's education within our organisation to understand that if the sales guys or the contract negotiators are negotiating particular clauses, what does that mean for accounting? This standard isn't just for finance teams to understand. We have to make sure that the whole of the organisation who it's relevant to understands, at least at a very high level, the type of clauses that could affect our revenue accounting. Performance obligations are probably the area that I'm finding entities are struggling with the most. And it's because it's a brand new concept. We've never had it before. So they'll say, well, we'll look at the contract and it's got progress payments in there. The progress payment will not be the definition of a performance obligation. We've got progress reports. That won't meet the definition of a performance obligation. For the first time ever, we have to put ourselves in the shoes of the customer and say, can the customer benefit from this thing that we have provided or that they've paid us for? If they can't benefit from it, it's not a performance obligation. So we talk a lot about unbundling and pulling apart contracts. We also have to put them back together to make sure that we've got performance obligations. So some of the common ones I'm seeing, and I've talked about before in respect of upfront fees, and I've talked about joining fees, but I want to expand that based on what I'm seeing. Implementation fees. If you are going to perform a particular service for an organisation, and let's take software as an example, I'm going to provide you with software service for the next 3 years, and you've signed up for that. In order to do that, there's an implementation fee. I've got to come out, I've got to configure whatever I've got to configure, and I charge you for that. I might charge you $100,000 to do that. In the past, the software company has said, well, we've done it, we've configured it, we can then recognise that $100,000. Can the customer benefit from that implementation work? No. The only way they benefit from it is through the software that they get. So they get the benefit of the implementation service as they receive the software, because in its own right, to know that your system has been implemented and configured, that's great, but I can't use it. So the $100,000 now gets spread over the 3 years, not recognised immediately on receipt. Under this standard, we see more deferral of revenue because we haven't actually done what we're supposed to do in its totality. So implementation fees, setup fees for construction and mobilisation fees. We've charged you an amount to get the plant and equipment on site. Can't benefit from it until they're actually, doing the work. So any of those upfront fees, even though you've received the cash, doesn't mean that it's revenue under the standard. And that's a key. We still want very closely our cash to be equal to our revenue. We're not cash accounting. And unfortunately, this standard is probably taking us further away from that, further away from where the tax rules are. So when we're looking at our performance obligations, can the customer benefit from the thing we've provided? We also have to think about what if we don't receive any cash for it. So let's take a financial planner. And I go to see a financial planner and they present me with a free financial plan that's incredibly detailed, and I could take that away and I could implement it myself. Now the reason they're giving me this plan is because they want me to go, that looks fantastic, will you do all of this for me? But because I can benefit from that financial plan, there is some revenue that can be recognised because you have completed a performance obligation. So you obviously estimate how many people will take it up and how many people won't take it up. There's no revenue recognised if I'm going to walk away and do it myself. So we have to think about, in the second step, what are the promises we are giving our customer? It's not when do we recognise the revenue, we can't leap into that straight away. It's what are the promises, the performance obligations that we are agreeing to do for our customers. And that's when we identify those performance obligations, and we account on a performance obligation basis under this standard. So not payment milestones, not progress reports, no upfront fees. We have to think about what are we actually doing that will meet this. Now again, I've talked about education in your organisation, and I've talked about getting more help. When we're writing tender documents, proposal documents, if we could get them written on a performance obligation basis, that would be helpful. We have to cost the job to be able to do a proposal. If we can cost them at the performance obligation level, again, it makes everybody's life so much easier. So working out who's involved in this, what information do we need to give them. Step 3 is all about determining our transaction price. So we have to think about what can make our consideration vary. Is it bonuses? Is it penalties? Is it certain KPI performances that will help to vary? Is it refunds? Is it discounts? All of those things will come back to the expected consideration, because this standard is all about what is the expected consideration from this contract. Now, to apply a bit of a pragmatic view, we kind of say, well, the only reason we're worried about if consideration can vary is if we are able to spread our revenue. If you're recognising revenue at one point in time and there's no ongoing components to that, we don't need to worry because we know at that point in time what the revenue is going to be. If our project is done and dusted within our financial reporting period, so for the listeds that could be in the half year, for everybody else it's in the full year, we don't care because at the end of the time it's finished, we know the answer. We don't have to spend time thinking about that expected consideration. But if you cross a financial reporting period for your project and you are able to spread your revenue, you need to work out what is the revenue you expect to receive from this particular contract and look at what makes it variable. We often have a contract price and we think that's it, but there's very few contracts that is it. There are so many clauses in contracts that cause the price to vary. Step 5 is all about transfer of control, and that's the concept of this standard. Have we transferred control of a performance obligation, that promise we're agreeing to do, to the customer? How did we transfer control? Did we transfer it at a point in time? And point in time is the default answer. So the point in time will be when you have completed the performance obligation. Or do we satisfy the requirements for continuous transfer of control? And I've talked about that in the past. There's a number of criteria that we've got to go through. At the moment, if we want to use percentage of completion, we just use it. Under this standard, if you want to use percentage of completion, you've got to jump through hoops to prove that the transfer of control of the performance obligation is continuous. So any of you who are currently using percentage of completion, your answer can't be, it has no change for us, without having documented it and proving that you still meet those criteria for percentage of completion. We've seen a number of organisations that are no longer able to spread their revenue. They recognise it at the end of the project.
What sort of things are causing them to change that?
So it's generally about, so if we take construction industry, for example, that's the classic one. If I'm building a set of apartments next door, nobody gets control of that as it's being built. There's alternative uses for them, so if we're all due to buy them and one of you pulls out, then all I do is I sell it to somebody else. So up until the point that you actually hand the keys over, you have not transferred control of that. If we are doing things that we are working on something for the customer, a particular project, it could be we're building something for them, and up until the point that we hand it over, it's got an alternative use, we could sell it to somebody else. We can recognise that at the point in time. With an implementation project, that's a bad example because I've said that's not a performance obligation, but a particular project that you're working on something, let's say an architect, and an architect was designing some drawings for us. We would look at that and we would say that based on the agreement we've got, we say that we'll invoice you throughout the life of the contract. But if you pull out at any point, all we get back is a cost recovery. That means it's point in time recognition. The only way we can spread it over time is if what we get back is cost recovery plus an appropriate margin, because it doesn't have an alternative use to us. We can't do it for anything else, very specific, and we've got to be able to constantly get back the benefit that we have put into it, including a margin.
So taking your construction example,
Yes.
where the owner is actually paying by instalment,
Yep.
if they default, does that mean you're actually not satisfying the life of the contract recognition?
So in my apartment example,
Yeah.
you think you're going to settle, but you actually can't settle. So then I would sell it to somebody else, and the deposit that you have paid that is non-refundable, I would then recognise it as revenue then, and then I would recognise the revenue because I've just sold your apartment to Darryl, and I recognise his revenue as well, but it's at that time.
But you don't know until that actually defaults.
Correct, so it's at that time that it's defaulted, yeah.
So you think you're going to settle.
Yes, so hence you don't recognise any revenue.
Oh, okay. So even though you're doing it on instalments.
Correct. So that's it's just because you've received the cash doesn't mean you can recognise the revenue. So what you would be doing, you'd be debiting cash and you create a contract liability on the balance sheet. Just sits on the balance sheet up until the point in time either that you settle or you default, and then I recognise any deposit that I don't have to pay to you, plus Darryl's money because he's just settled very quickly. Yeah. So we end up with more balance sheet entries. We will have more contract liabilities sat on our balance sheet, which from a tax perspective obviously causes issues, because as soon as we have different assets on the balance sheet, what's the implication for deferred tax? One of the other areas that people are really struggling with is the costs. Why do we talk about costs in a revenue standard? Because it was in the construction contract standard, and that standard has gone. The International Board didn't want to lose that information, so they put it in here. They also didn't want to make it sector specific. So it's all entities now have to consider the costs. Two types of costs that we've got within this particular standard. Cost to obtain a contract, and that's an incremental cost. I wouldn't have incurred this cost had I not obtained the contract. Things like legal fees, things like sales commissions. At the moment, we've got a fair number of entities who pay fairly significant sales commissions, and they just expense them when they win the contract. Under this standard, if the contract is more than 12 months long, you have to capitalise those costs and you release them on the same basis as the revenue. So I'm working with a number of software companies at the moment, and they pay out fairly significant sales commissions to their sales guys. So we're trying to track how we do that, how we monitor, and what's the life that we spread it over. And the answer to that is it depends as well. Because if I've just won a 3-year contract and I paid my salesperson 20 grand, makes sense, you'd think inherently, to say, well, okay, 3-year contract, we'll recognise the 20 grand over the 3 years. But then we look and we say, well, what happens if that contract's renewed? I expect it to be renewed. I expect my average customer life to be 6 years. Well, if it's renewed, I only pay my sales guys $5,000. So a very big difference. And that's normal because there's less effort to renew than to win. Standard says we don't care about the level of effort. So the actual commission for the 3 years is only $5,000. So that extra $15,000 that you paid up front gets spread over the customer life, which is 6 years. Sounds overly complicated, and I probably agree with you. It is. But unfortunately, it's all about expected customer life and spreading that cost over the revenue. So any of you who pay sales commissions, please look at this and actually try and come up with a process. We talk about what contracts we have to restate. Now, if you've got ongoing contracts and you paid sales commissions 5 years ago, you have to look at that commission and say, should I be spreading this? Do I need to then reverse that expense at day one? So depending on where you are, we'll take a December year end, that's 1st of January 2018. And I reverse that expense, recognise the remainder that I need to spread at that date on the balance sheet and pull it out. So cost is equally as complicated as the revenue side. We need to have a process in place for that. Cost to fulfil a contract are the other type of costs that are recognised under AASB 15. So let's take my implementation costs for my software company. They've obviously incurred a significant number of costs to go out to the client and to implement, to customise, to configure the particular software or hardware, whatever it is they're looking at. They capitalise those costs because I'm spreading the revenue, so hence I have to spread the costs. Certain criteria that have to be met, the costs can't be in the scope of another standard, the costs have to be specific to the contract, they have to be actually to satisfy a performance obligation, and we expect them to be recovered. If they meet those criteria, again, we're spreading those costs out. So we have more assets on our balance sheet, contract cost assets that we are capitalising. We need to check whether they're always still recoverable. We'll need more disclosures around them. So it's costs and revenues we need to focus on. I also want you to think about at transition which contracts we have to restate. So everybody's got it in their head that it's these open contracts, anything we've still got on our transition date, we have to restate. But what if you offer a long warranty period? What if you offer a warranty period of 10 years? And you worked on a client with a customer 8 years ago. You offered a 10-year warranty period, so 2 years worth of that warranty period still exists. That's still an open contract under this standard because you have not yet satisfied all of the performance obligations. So not only are we looking at the things that we are still working on, if you have got any of those, particularly those extended warranty periods, we need to look back and say which of our customers, which of those projects are still within that warranty period. We need to reverse a component of the revenue that we've already recognised and spread it over that remaining 2 years as we satisfy that remaining performance obligation. So you can see, looking at the things that we are still working on, if you have got any of those, particularly those extended warranty periods, we need to look back and say which of our customers which of those projects are still within that warranty period. We need to reverse a component of the revenue that we've already recognised and spread it over that remaining 2 years as we satisfy that remaining performance obligation. So you can see every time I talk to you, I throw more issues at you. And this is what we're actually seeing practically out there for the entities who've started implementing. There are not many entities who have actually spent significant time and effort on this. So I always say my aim is always slightly to scare you, and if you leave and you start working on it straight away, fantastic, I've achieved what I wanted to get. Please consider how much work is involved in this standard for pretty much every organisation. Few traps I just wanted to talk about. A lot of entities say to me, I just want to know how I recognise the revenue. You can't. You've got to go through the 5 steps in order, because if you don't appropriately work out what your performance obligations are, you can't work out what you are recognising the revenue on. And the implementation example is a great example, because you go, I've done the work, therefore I must be able to recognise the revenue. But because it did not meet the definition of a performance obligation, you can't recognise any revenue even though you have completed that component of your work. So we've got to identify those promises, those performance obligations, and then we look at when can we recognise the revenue for them. Underestimating the time taken to do this is significant. It's not a quick and easy job to be able to just do it. If you think about all the number of contracts that you've got, all the individual types of contracts, this could be contracts that you're tailoring yourself for your customers. It could be customer initiated contracts. It could be that if you've got projects that are long term, you change your contracts every 3 or 4 years. So therefore you've got to go back and look at what is the contract that's in place for that particular project. We're not just looking at today's contracts. Ignoring associated costs, I've talked about that. Not communicating the impact with employees who negotiate sales contracts. Nobody really gets excited about accounting standards, let's be honest. So if you start talking to other employees and saying, we've got to tell you about the new accounting standard, you can imagine what their reaction is going to be. However, it's so important that they know how the clauses they're writing could impact revenue. It could impact their bonuses that they're earning. That will get their attention. It could impact what we're reporting against budget. That will get their attention. So if we actually start looking at this and saying, we need them to understand it, because otherwise, if nobody understands the impact at that level, who will be blamed for the way the financial statements look? The finance guys. So therefore, we've got to have that conversation. If you choose not to restate, and to be honest, that's what I'm seeing. I'm seeing most organisations who are choosing not to restate comparatives because they're so unprepared that we haven't actually got the ability to go back that extra year. Don't forget that you actually, in the current year, so for December year ends, that is 31 December 2018, December for profit year ends, the June year ends, it's 30 June 2019, not for profits is 1 year later. You have to report both numbers. You have to report the numbers under the new standard and what the numbers would have looked like under the old standards, because that's how we get our comparability. We can compare old to old, and then next year, the following year, will be new to new. So 2 sets of numbers are required to be reported in the first year you adopt these standards. That is for for-profits and not-for-profits, if you choose not to restate. Obviously, if you've restated your comparatives, we've got that comparability in the primary statements. Not-for-profits, your big issue is which standard is relevant to you. So I haven't spent time focusing on the not-for-profits today, but you've got 2 standards, remember to do that. While I'm in the not-for-profit space, I just want to give you some breaking news. One of the biggest issues that not-for-profits have got is in relation to peppercorns. And I've spoken before about if you've got a peppercorn lease or a lease significantly below market value, you are required to value the right of use asset, which probably required the use of a valuer. As of late last week, I received my board papers for the board meeting in Sydney on the 13th of November. There is a proposal that is going to the board that proposes to grandfather peppercorn leases. There's actually 4 proposals, or 5 proposals. One is to do nothing. One of them is to grandfather existing peppercorns, so therefore you ignore them. For private sector not-for-profits, One is to grandfather new and existing peppercorns for private sector not-for-profits, and the other two options are for all not-for-profits, including the private and the public sector, but we haven't got any public sector people here. So I just want you to be aware that that proposal is going for the board. I genuinely cannot tell you what that answer is going to be. I don't know what the board are going to vote on. 13th of November, the state is in Sydney, so if any of you want to come along for the discussions, it would be great to see people. It's a public meeting, so therefore you will know the outcome straight away. Whilst it is just then a board decision, there will be a very quick exposure draft that comes out. I think the proposal is a 21-day exposure with a standard out by the 20th of December. So my key message is, if you are in the not-for-profit space and you have peppercorns, please pause any work that you're doing on it now. I don't want you incurring any more costs. I don't want you putting any more effort in if the board are going to turn around and say grandfather them. The reason for that is twofold, partly because of the ACNC legislative review, that we don't think it's appropriate that we might be requiring you to do some work, and then the ACNC changed their legislative, the financial reporting thresholds, and therefore you've actually dropped out of full general purpose accounts. The second reason is we are being told how much work is involved in this, so we just want to look and say, is it giving us the right answer? So that's my breaking news for for-profits. Please don't do much more work, or don't do any more work on your peppercorns until the decision of the board meeting is known. Another trap is not focusing on material revenue streams. You might have some really complicated revenue streams, but they're actually really small. So don't spend any time doing it. You're really focusing on material revenue streams, and that's where your effort has got to be. I put this one in from a discussion I had with one of my clients, and it's a corporate entity. I've been out there, I've been helping them, we've implemented AASB 15 and everything was happy. I went out there and I gave them a training session on some other things, and they said, okay, give us an update on 15, what are you seeing? And as we were talking, one of the people just kind of had this awful, horrified look on his face, and I said, what's the matter? And he said, we did this, they're a March year end, so he said, we did this in April. So all done, dusted for the 1st of April 2018. And he said it has just clicked that we have not looked at any revenue contract that has been issued by this company since 1st of April 2018. We kind of got so excited in the transition and went, that's it, we're done, we're dusted, that we forgot that it was ongoing. Now that was a really big eye-opener for me, because I kind of thought we've gone through the whole process, it's done, but every time you get a new contract, you will have that look and see what the impact is. So please don't forget that these standards are ongoing, and we need to keep looking at all new contracts that we've issued, and not just forget and think we've done it at the opening balance sheet day. Questions, comments on revenue? Yep.
Hi, we report under IFRS and US GAAP.
Okay.
If the revenue standard is converging or diverging with US GAAP.
So when this standard was issued, it was identical. The US GAAP and IFRS was identical. They then set up, the International Board and the US Board set up what they called a transition resource group, and they made some changes to the standard based on feedback they were getting. It was still identical. The International Board then said, okay, this is ridiculous, we can't keep changing a standard that is not yet in place. We have to draw a line in the sand. So they abandoned their transition resource group. The US kept it going. So there are some changes to the US standard. I have to admit, I'm not completely on top of what they are. So I think they're still fairly close. There will be some differences, however, based on the US transition resource group. But fundamentally, the idea was all the same. The US aren't coping very well with it because they're very much used to rules-based standards. If you have this, you do this. And that's not what this standard is. So that's why they kept their transition resource group and are trying not to turn it into a rule standard, but are struggling a little bit to break that.
The implementation of the US GAAP on a similar time frame?
Yes, exactly the same time frame for their listeds. Yeah.
Service contracts, service over time.
Yep.
Or it might have a report at the end of it. What impact does it have if the contract has a clause in it that says, if you terminate me, you still pay me for costs incurred or something?
So if it just says if you terminate May costs incurred, then you'd still be recognising revenue at a point in time probably, which is at the end of the contract. If it says that you will, if I terminate the contract, I will pay you costs incurred plus an appropriate margin, then you could get into overtime. So it's altering one clause within your contract would actually significantly impact how you recognise your revenue. So when we see the words enforceable right to receive payment for work performed to date, which is actually the words in the standard, what that means is if the customer gets rid of you for any reason other than poor performance, they have to compensate you. If they got rid of you halfway through the contract, they pay you half the contract value, effectively. So it's not just your costs incurred to that date, it is half the contract value, so you do still get a margin on it. So let's move into looking at some of the others. Financial instruments. Outside of the financial institution space, this is probably the standard that I'm seeing the least impact. However, because we keep harping on so much about how many changes are under the revenue standard, I do suspect that many entities have forgotten about the financial instrument standard that kicks in. So a few things I just wanted to talk about. If you do have any investments, so an investment in a listed entity or investment in an unlisted entity, it has to be carried at fair value. There is no longer a cost exemption. That is not investments in associate subsidiaries, JVs, so it's anything below that level. So first thing, we have to hold them at fair value. Second thing, you need to work out whether you want the fair value movements through the P&L or through other comprehensive income, which is effectively a reserve. How do you make that decision? If they're instruments held for trading, you have to put them through the P&L. If they're not, you can choose. You can choose where you want the fair value movements. If you choose P&L, you don't need to do anything because that's the default answer. If you want it to go through a reserve, through other comprehensive income, you have to, what the standard calls, designate it as other comprehensive income. What does that involve? A director's minute that just says, for all of our investments, we're choosing to designate them through other comprehensive income, unless we decide otherwise. I would do a blanket one that gives you the default answer that you want, but gives you the option to choose otherwise if you need to.
So can you mix?
You can mix. It's on an instrument by instrument basis. Yeah, so you can have some at P&L, some at OCI. The big advantage of other comprehensive income is that you are avoiding any of those unrealised gains or losses going through the P&L. The disadvantage of it is the only thing that goes through the P&L is dividends. So when you sell those investments, any gain or loss that you make stays down in the reserve, gets transferred to retained earnings, but never goes through the P&L. So people love the fact that they're avoiding the impairment through the P&L, don't like the fact that if they made a gain on sale, it also doesn't go through the P&L. So there's ups and downs for both of them. My preference is probably to put it here because I don't like the huge swings and roundabouts that you often get through the P&L in relation to that. And we've seen it over the last few years. So it's not the same as your available for sale investments, it's different treatment. In regard to receivables, we are changing models from an incurred loss model to an expected loss model. And that means that on day one, we have to say what loss do we expect to receive from this particular invoice that we have raised. The standard is written to say the existence of credit risk should mean that you expect to make a loss on every receivable. I don't know if I necessarily agree with that, but that's the way the standard has been written. So instead of waiting until the debtor gets old and putting through a provision, we will see earlier recognition of bad debt provisions. Your disclosures around this have also changed. You have to explain how you've looked at the credit losses, you have to explain your process around this, and have to do some fairly detailed disclosure in relation to this.
So that means the old system, people would have a general provision that got taken away. It's kind of coming back again.
Potentially, it's kind of coming back again. And some of the disclosures I've seen, which are from the international standard, are, well, if it's greater than X number of days, then our expected credit loss is X%. If it's greater than this number of days, it's Y%, which is exactly what you say. It's our general bad debt provisions we've spent the last 15 years trying to get rid of. You just need the rationale for why you've come up with it. You need to make sure you're looking at forward information and not just historical information as well.
And could it be as simple as something like our historical loss is, 1% of sales?
I think so, but what we're generally seeing is it's broken down and saying if it's current, then we believe that on those the historical loss will be 0.5%. As we start getting to greater than 90 days, our historical loss is getting up to about 40. So people, I haven't seen anyone actually go that, let's just go 1% across the whole portfolio. I'm seeing that
But on day one, you're going to have to estimate that some of those sales
correct.
are going to get into 90
Yes.
days.
Yeah.
And if they do then, and come up with a percentage on day one.
Yes. Yeah. So it's
So you can't wait till 90 days and then start.
correct. So it's quite challenging on how we do it. So I guess when we look at this again from a pragmatic perspective, do I expect entities to do this on day one? Probably not. I realistically expect it to be a year-end adjustment. And the disclosures that the International Board have put in kind of indicate that that's probably what they expect to see as well. But it will be a transition adjustment. I do expect on transition of this standard that there will be an increase in all of your bad debt provisions. So that will flow through. We'll see that as part of the statement of changes in equity as well. Classification, even if you have no change in anything else, all of the financial asset categories have changed. So we no longer have the loans and receivables, the available for sale or held to maturity. We do still have fair value through P&L, but the other categories are amortised cost, fair value through other comprehensive income for equity instruments, and fair value through other comprehensive income for debt instruments. So as an absolute minimum, we still need to change all of those within the financial statements. The disclosures around this standard are fairly significant. So on transition, there are a lot of disclosures around how have your categories moved and shows the old category compared to the new category and shows your reclassifications and your remeasurements. There are also disclosures, significant disclosures around your bad debts and how has that changed. Significant disclosures on transition, but also don't forget the extra disclosures that come through on an ongoing basis. So AASB 7, our disclosure standard, has changed because AASB 9 kicks in, so it will not be the same as what we're used to reporting. Some of the challenges around leases that we've got, and I'm not going to go into quite as much detail on this standard purely because we have an extra year technically to implement it, although for December year ends, 1st of January 2019 is when we should be on board with this standard. Huge concerns around what is a lease. So as I've mentioned before, it is not just picking up the leases folder and saying this is all our leases. We need to look at what else could meet the definition of a lease. Any agreement that you have got that is asset backed, so it's linked to a particular asset, you need to consider whether it meets the definition of a lease. So things like IT outsourcing, if you're leasing the black box server, maintenance vehicles, I've heard lately, where you've outsourced the maintenance of particular assets, but those vehicles are labelled with your name, they can only be used on your jobs. You let them know every day where that vehicle needs to go based on the maintenance requests that have come through during the night. So potentially there's a lease over those vehicles that you've got. So don't just focus on what have I got that's called a lease. We need to think about what we've got that is not called a lease that meets the definition. Lease versus non-lease components. So this is where you have a choice within the standard on whether to separate those or not. So an example is if we take this building, you would have all have come up here using a lift. HLB does not lease that lift. It is a common area, they do not have exclusive use of it. Therefore that is a non-lease component of this lease that they've got. Standard says you can either work out of the, I have no idea how much you pay Darryl, so I'm just going to throw a number out there. We'll call it $1,000 a week, that you're going to tell me you wish. But so $1,000 a week, of that payment, how much is for the non-lease components? How much is for the use of the lift? How much is for the use of the lobby? How much is for the security services, the maintenance services? And pull that apart, or your choice is not to. You just account for the $1,000. Whilst that's much easier, if you are particularly sensitive about your debt ratios, it will mean that your liability is actually much higher than if you had pulled it apart. Discount rates and what discount rate should we use? The standard very helpfully tells us that we should use the discount rate implicit in the lease. I have not yet seen an operating lease with a discount rate implicit in there. So I'm still hoping that we use our game of let's pretend with the bank. Let's pretend you were going to give us a loan. What rate would you lend it at? How do we deal with increases in rent, with CPI increases, with fixed increases, with market rent resets? How are we actually going to track that? Subleases, if you have any subleases and you are that middle body, so you're a lessee to the head lease, but you're a lessor to the sublease, accounting is a mess. So please have a look at that. Lessees and lessors have different models, and if you are that middle person in a sublease, you're in both of those models. Think about your make good clauses. So I've talked about them in the past. That is actually an error if you have not been putting make good provisions in your financial statements. So if they are material, we need to work out how we're going to deal with that. Are we going to blame through AASB 16? I suspect that will be what happens. AASB 16 hasn't changed the need for a provision, it has just changed where the debit side goes. So it now is debited to the right of use asset. So if you still aren't convinced, sorry, yeah? For lease incentives. So it depends on what the lease incentive is. If it was something like a rent-free period, that's already taken account as part of your liability, because you've lowered your liability. If you've got something like a fit-out cost, then you take it off the right of use asset. So if you still aren't convinced about how much work is in this standard, have we thought about the big picture issues? And this is where you're going to get the buy-in from everybody outside of finance. Do we need to get changes to contracts or agreements? That could be lease agreements, it could be revenue contracts. Under the leasing standard, we are bringing on more assets and more liabilities. They will not necessarily be the same, so there will be a net asset difference. But one of the things we have to think about is the threshold under the Corporations Act is based on gross assets. You are bringing on potentially huge right of use assets. Your gross assets will therefore increase. If you are meeting one criteria, so there's 3 criteria in the Corps Act, the revenue one, a gross asset one and an employee one. If you currently meet one of them, this could push you into meeting 2, which means lodging financial statements with ASIC. So you need to be aware of that, you need to start thinking about that, have a rough play with the numbers and be on top of that if you have to lodge, because potentially your financial statements will have to change. Those of you who are listed, think about your continuous disclosure requirements. So if you are aware that your financial statements will be materially different from what's previously happened, you need to announce to the market. We're not seeing a huge amount of announcements. Myer, I think, were in the Fin Review maybe a couple of months ago now, and they said their liabilities are going to double when AASB 16 comes out. Now, the more kind of big entities we're seeing making big announcements like that, the more we'll start to see, I think, more continuous disclosure, because people will actually go, actually, it's an impact for us too. Think about your dividends. If your dividends, I've lost my pointer, there we go. If your dividends are based on revenue, your dividends are based on profit, your dividends are based on EBIT or EBITDA, potentially you are going to be caught by paying more or less dividends than you wanted to because of that rule that you've set up. IT systems, how are you actually going to capture this information from both the revenue, the leases, and your expected credit loss perspective? You need to start working on this. Excel is a wonderful tool, but it is not a substitute for a financial reporting ledger. So you can't have too many things running off Excel because there's too many risks around manual intervention and misstatements. We've talked already about what you're going to do about your management accounts and budgets. So we should have already taken them into account for the 4 profits in the room in relation to revenue. For the leasing standard, we need to consider what are we going to do. Are we going to attempt to push all this through as a period 13 adjustment? And I'm sure there's a lot of entities who think that's what they're going to do. I think it's going to be really challenging to actually do that. Bank covenants, particularly in relation to the leasing standard. If you are a December year end and the standard kicks in on 1st of January 2019, you are potentially in breach of your bank covenant at that point in time. If it refers to accounting standards and the solvency ratios, the current ratios in there, you need to have that discussion sooner rather than later. In an ideal world, the banks would be fully aware of these new standards and would be fully aware of the impact. Their finance reporting teams are. The guys writing the loan covenants are not. Bonuses we've talked about. If you have a bonus that is linked to revenue or EBIT or EBITDA, you need to look at it, particularly any that are linked to EBIT or EBITDA, because the leasing standard will cause EBITDA to go through the roof because we no longer have rental expense, we have interest and depreciation. The employees are going to love it because they're going to get huge bonuses, but nothing because of their performance, purely because of an accounting standard change. If any of you are out there buying businesses or have bought businesses over the last few years, that included an earn-out clause. So I will pay you X million dollars today, but if EBIT goes up by X percent or revenue goes up by Y percent, we will pay you an additional $2 million. It could well be that it changes. Nothing to do with the performance of the business, to do with the performance of an accounting standard or the implementation of a new accounting standard. So please, please make sure that you are aware of what's in your agreements. Again, in an ideal world, we'd expect that the lawyers were aware of it. They're not. And education of the non-finance staff, I've talked about that a fair bit already. We need to make sure that they've got that understanding, because you guys aren't the ones who are doing these agreements. You're not the ones writing the contract. You're not the ones writing the lease agreements. So entities, the people in your organisation who are, need to understand the impact of this. So any more questions, comments? I think Darryl gave me till 25 to, I've got 3 minutes left for questions.
I've got one on the leases. If you have a current finance lease,
Yes.
is it okay to say nothing changes?
So with a current finance lease, what the standard allows you to do, so I'll go back a step. With a finance lease, you've got, let's say it's a vehicle, you've got leased vehicles sat within your vehicle's PP&E, and then you've got a lease liability. What the standard says is don't shift your lease liability, leave it exactly the same. Credit vehicle, debit right of use asset. So you're not changing the balance, you're just reclassifying that asset, and then going forward it will be just under AASB 16. Yeah.
Thank you very much, James, for the introduction. Carmen, for your presentation this morning. Now, I'm going to switch direction a little bit and take you on into the wonderful world of tax. So, 2 areas I wanted to touch on a little bit today, to touch on in particular corporate tax, relevant to hopefully a number of you here. The changes to corporate tax rates. Now, I've got a partner who works in wealth management, and the extent of his knowledge he tells me about corporate tax is corporate tax 30%. Well, I'm really thrilled that we now have 2 corporate rates of tax, so I've got something to sort of share and have in common with him, or at least discuss. The other thing I wanted to talk a little bit about today is the new significant global entities penalty regime. Because in a lot of cases, you sort of look at this regime and think, oh, that doesn't really apply to me, to my business, to my enterprise. But what we are seeing here is a number of taxpayers who are encountering some really unexpected outcomes, particularly negative unexpected outcomes. And that's where I suppose it bears looking at in a little bit more detail as to what you need to be careful of. So I've got a couple of themes here for today. One is corporate tax reductions. They're easy, right? Corporate tax stops. That's really easy. We pay less tax. That's a good thing. Right, well, it's actually, like all things in tax, you take a fairly simple idea and you make it fiendishly complicated so that a lot of taxpayers have a great deal of trouble trying to work out exactly how to pay the right amount of tax. And the other theme that I wanted to draw out a little bit more today is that both of the things that I'll discuss today will affect the entity that you're looking at, or a taxpayer, or a group, or a reporting entity. And the tax impacts and tax risks that flow on from that are very much determined by the ownership chain that that entity sits in. And so it's for that reason that, especially if you might have a bit more of an, let's call it opaque ownership structure that sits above your business or your entity, really important to understand what that chain is and how it impacts your tax risks and how it impacts actual tax liability. So, a lot of taxpayers want to know, what is my tax rate? Seems a fairly simple question, doesn't it? Well, I understood this was 30%. Well, now it's 27.5% and some 30%. Oh, right, so there's a choice. Okay, can I have the lower one, please? And what is that? That's okay. So this is a thing called the base rate entity. There's been a lot of toing and froing over the changes to corporate tax. You've probably seen a fair bit of debate about who would be eligible and who's not eligible. So we now have some rules clarifying that, and the tax office has also released a bit of guidance about who is one of these things, a base rate entity. That is somebody who can enjoy the 27.5% rate of corporate tax, or are you in that residual bucket of, yeah, I just can't pay 30%, just as I always have. And you probably recall it was a proposal that over time there'd be substantial reductions for that residual 30% rate. But like all things in relation to the political football that is corporate tax, there's no plans for that to proceed at the moment. Am I a base rate entity? Looks simple. You just meet two requirements. Then you're a base rate entity, 27.5%, easily done. So, I'm just going to meet these two tests. So, simply put, you need your aggregated turnover for the current financial year to be $50 million or less. You also need less than, no more than 80% of your assessable income to be this thing called BREP. Now, sometimes I get the feeling that taxpayers think to themselves that the tax system is set up so that we can create extensively long acronyms such as BREP. So we'll get to what BREP is in a second. Base rate entity passive income. Unnecessarily lengthy term for a fairly simple idea, really. So if you satisfy both of these two requirements, that is that your aggregated turnover is less than $50 million, and also that your no more than 80% of your assessable income is this BREPy idea, that you will be a base rate entity, therefore eligible for 27.5% rate. Now, when you run through the ATO guidance on this particular issue, one thing that they're very keen to point out here is that last dot point there, that they have no discretion in relation to the tax rate that applies. So what I can see happening quite frequently is that for some unknown reason, you do a transaction, you have a change in your ownership structure, which means that you get aggregated with different entities, or for some reason you have a really material capital gain in that particular year. You can fail either one of or both of these tests in a way which you just didn't expect and couldn't reasonably have expected beforehand. And when that happens, although you might have been a base rate entity before, you can go to someone not being eligible. Or equally, you could actually have the opposite situation occurring. So in a lot of cases, corporate groups might have, you see that there's been a transition of the base rate entity from 25 to 50 million. So if you're in that gap between 25 to 50 million, some taxpayers are in fact going from being a 30% taxpayer to 27.5% taxpayer. So you don't have a choice about that, and neither does the tax office. So aggregated turnover, sounds like a better term, doesn't it? What is aggregated turnover? So, well, it's your turnover, that's the obvious bit. What do we mean by turnover? Now, turnover in this context means all of your ordinary income. So it's not all those, I'd call it tax fictions, like attributed CFC profits and things that don't exist in the real world. It's ordinary income.
Ordinary income for tax.
Ordinary income for tax, yeah. So
not unrealised gains.
Not unrealised gains, yeah. And so this is where it starts to get a little bit tricky. So it's not just your turnover, but it's also anything that's connected or affiliated with you. That sounds a bit loaded, doesn't it? So connected and affiliated means, in a simple sense, anyone who, if you have somebody who has 40% interest in you or more, that will create, in most cases, a connected entity. So if you have a sister entity and you're under common control, you can be in a situation where that sister entity's turnover is aggregated with you. And I think it's sort of useful to sort of think about if you've got an ownership chain, what other sister entities might you have? What other entities are you under common control with? Because when you're coming to that to aggregate turnover test to work out what's your right rate of tax, you have to include those entities. So BREPy, that wonderful term there. Base rate entity passive income. That's my attempt at humour there by just saying it's concisely titled. Base rate entity passive income is all the stuff that you would ordinarily have thought of as being passive. So it's interest and dividends where you don't hold more than 10%. Royalties, interest. Interestingly, it also includes capital gains. And that, I think, could be quite a tricky one because I'll get to an example of where that really doesn't agree. Now, what happens here is that passive income there, you kind of think about that as the tainted or the income that will take you outside eligibility if you have too much of it, more than 80% in this case. So if you've got more than 80% of your income for your entity, and it's assessable income here, so that's including all the tax fictions, it's got to be, to qualify for the lower rate of tax, you have to have 80% or less of your income being this base rate entity passive income. So if you've got an active business, not a lot of passive income coming through, in a lot of cases you'll find that your base rate entity passive income is very low when there might be bank interest. We have royalties, for example. So that's just a bit of a list there of some of the things which are income which counts towards your REC testing. Now, I thought it'd be interesting now to get down to a couple where I see the real friction points coming out of working out what your corporate tax rate is. So the way the law is working currently is that you do your current year tax expense based on what's happening in this financial year. And so in some cases that can involve a little bit of uncertainty because you don't actually know until you get right to the end of the year. Like let's say, for example, you are proceeding along the way like it's standard balance, so you get to 1 July, your business is operating. You think to yourself, okay, well, base rate entity passive income's fairly low, it might be a couple of percent. Oh, I'm about to do a transaction and a sale of business. Sale of business, if that yields a big enough gain, will be treated as a capital gain. Capital gain is included in your base rate entity passive income. And if that capital gain is material enough, you might find yourself in a situation where if I was an operating business, I would have been a base rate entity. Now that I've got this big capital gain coming through, that might be enough to be more than 80% of your base, of your total assessable income for the year. And a flow on from that would be, okay, well, I've realised the capital gain 80%, where I always thought I was 27.5, unexpected outcomes. The other thing that's a little bit confusing about this is the ranking rate is actually determined by your last year's corporate rate. So in a lot of cases, if you're starting up, you go, well, what should my rate be? Now, ordinarily, you should default to the 27.5%. But also, if you're changing between rates, it's important. So when these tax rates drop, ordinarily taxpayers would think that's a great thing. But it's, in a lot of cases, not so great for your shareholders if the accumulation of profits has happened to 30%, and suddenly through a tax rate drop, you find that the imputation you can attach to your distribution is only 27.5%. And that's not entirely accidental. It was, in fact, part of Treasury's means by which it proposed to pay for these corporate tax rate changes, is that shareholders, in a lot of cases, profits might have accumulated and taxed at the old rate of 30%, actually can only access 27% imputation when dividends are passed out once you drop in the year after the one in which you become a base rate entity. So, really tricky bits and bits where I see real friction coming about with these tax rate changes. I think one thing that will be really tricky here is that if you're owned by a fund, it could be paid, it could be some other kind of fund, do you know who your other co-investees are? And it doesn't have to be all of the fund, it could be just a 40% interest. So if you're in that situation, you probably need to find out, are there any other entities that you're aggregated with for the purposes of testing? Is my aggregated turnover over or under $50 million? If you just look at the entity that's in front of you, you could actually get to the wrong outcome. Get to the wrong outcome, you pay the wrong amount of tax. That's a fairly big risk. The other thing that I think will be interesting here is that as people move to and from base rate entity, moving from 30% to the 27% rate, it's quite possible that you might find that your current rate of tax this year will be quite different from the one that you employ in future years. And so will that then flow through into your ability to recover assets or to recognise liabilities for deferred tax? The third dot point there is one I've touched on just briefly, is that if you have a large or unusual transaction, you might find that you can fail the review tests and find yourself being ineligible to apply the lower rate of tax. Equally, if you're a target who's taken up over time or your ownership changes, you go from privately owned to held by a larger group or a fund, you might find that the actual rate of tax which applies to that particular entity goes up over time, because suddenly you're aggregated with a whole bunch of other businesses that you weren't previously. So that can actually make a significant impact on your post-tax cash flows, suddenly having to pay your tax at 30% instead of 27.5%. And that's probably what I'm getting to in that fourth point down the bottom there, is that when you're looking at a buy or sell case, don't make the wrong assumption about your future rate of tax, because you might find that you're aggregated with quite different entities for the purposes of the turnover testing if you have a change in your ownership structure. Now, I wanted to touch on significant global entities and how they've been affected by a few legislative changes and also to give you a little bit of feedback about what we're seeing in terms of the way the tax office is approaching these legislative changes. So simply put, the penalty regime that we all know and love from the tax office was, I suppose, a good deal more lenient in retrospect now. Up to the 30th of June 2017, most larger taxpayers faced, up to $900, in some cases a little bit less than that for 28 days of being late. If you're lucky, it's 180, 360. But I think connected with a lot of the concerns around the way that significant global entities interacted with the Australian tax system, there was a move to very significantly up the level of penalties that apply to these entities. So what I mean by an SG, a significant global entity, I'll get to that in a second. But from the 1st of July 2017, this went through the roof. It's now $105,000 for 28 days, so it's gone up by over 100 times. And that you sort of think to yourself, well, okay, so that means that if I'm a significant global entity, I'm going to be really sure that I lodge everything on time. But everything, especially for a significant global entity, and often these entities are have quite a variety of different tax compliance obligations that they have to follow. But it actually means any form that you lodge. It could be a payment summary, it could be an FBT return, BAS returns, taxable payment annual returns, a payment summary, consolidation notification forms, any of those things. Being late for 28 days, $105,000. And that's not the end of it, by the way. It can be, you can get up to 5 times that $105,000, so $525,000 just for not lodging something. It's pretty draconian. So, are you an SGE, significant global entity? So,